What is going on, Hot Take Nation? It is DRW here for another episode of the Hot Take of the Day podcast. Today, I'm very fortunate to be joined by Jay Bryson, who is the acting chief economist for Wells Fargo Bank and is based in North Carolina. Jay, welcome to the show. How are you today?
I'm great. Thanks for having me here today.
So North Carolina, big basketball town. How are you feeling about the fact that there was no Final Four, obviously, no March Madness. What was the vibe of the state?
Yeah, so I'm a North Carolina Tar Heel. I went to UNC, and many of my children also did as well. And actually, it was kind of good news because we weren't going to make it to the big dance this year. So our streak of like 15 out of the last 16 final big dances remains intact. But no, it's obviously not having the NCAA tournament here in a basketball crazy sort of place is. It was tough, but and just like all sorts of sports, it's things kind of shut down now. But we're all coping, and hopefully things will start to get back to normal pretty soon.
Good, and so we were chatting just before we went on air here about where North Carolina is in terms of the stay-at-home order, and South Carolina has obviously opened up with Tennessee. Georgia has opened up as well. Where's North Carolina in that spectrum of opening back up?
Right. So the governor a few weeks ago extended stay-at-home orders until May 8th. And that's the latest. So whereas South Carolina, is starting to gradually reopen, and some of those other states that you mentioned, we're not there yet. That said, it does seem like cases here, as in many other states, are they're still going up, but at a decreasing rate. The curve is flattening here, and we'll see what happens going forward. So, one thing that I did read today is that there's a NASCAR race here in Charlotte over Memorial Day, the Coca-Cola 600, that they always have. And in the paper today, the governor said he assumes that race will go forward. Now, whether or not there's actually fans in the stands, I probably not. It'll probably be in front of nobody, but they may, in fact, have the race later.
Well, that's great, and I'd read earlier that the first professional sport that was at least coming back after canceling was the PGA Tour,
right?
And it certainly seems like people are getting ready to get back to life. It'll be interesting. So talk to me a little bit about your background and what it takes to become a chief economist. And I think from context, a lot of energy professionals who listen to this show are thinking about a career change after the crazy double black swan. And so chief economist.
Right. So I've been doing this for a number of years now. I have a background so I have a PhD in economics. And I earlier in my career, I taught at universities, taught at the University of Alabama. I moved to the Federal Reserve in Washington, D.C., spent a number of years there. And then about 20 years ago or so, I came to, at the time, the bank was called First Union, which then became Wachovia, now Wells Fargo. And I've been here for about 20 some years now, and so started out as our global economist, watching what's happening in the rest of the world. But also, there's a lot going on, obviously here in the United States, that I had to keep a track of. And then, as the chief economist, retired about 2 years ago or so, I moved into that role.
So how over your 20 years? So I'm just thinking, going back, it was about 2000. So you would have been in a similar role, kind of around the tech bubble burst and the Y2K. The most similar pandemic was that all the computers were going to end. Right. January 1st was going to happen, and Y2K was going to melt down the world, and it was sort of a non-event. But it coincided with the tech bubble. Sort of took a long time to recover there, the Great Recession in 2008, 2009, and then now this. How does this compare to those events, both similarities and differences?
So, it's a cliche now to use this word, but I'll use it anyway. This is unprecedented. We have never seen an economy just completely stop altogether. The tech bubble, when you go back and you look at it, that turned out to be a very mild recession. It was a depression for the tech industry, but for the overall economy, it wasn't much of a recession at all. You thought that the global financial crisis was once in generation, if not lifetime sort of thing. This is completely different. This is where every part of the economy just shuts down. And even as bad as October of 2008 was, the entire economy just didn't shut down. So that's the biggest difference this time around. I think some similarities are, if you think back to 2008, you had the government got very active at that period of time, right? You had TARP, you had the Federal Reserve rolling out all its sorts of programs, and 12 years later, we're kind of doing the same sort of policy response. And so, I think the good news of this is we learned the lesson of the Great Depression. The Great Depression, there was a recession that was starting in the summer of 1929. That turned into the Great Depression because of an utter failure of policy at that time. The Federal Reserve did not do its job as the lender of last resort. Fiscal policy in this country didn't really turn stimulative until 1933, 1934, at the depths of the Great Depression. So we've learned that lesson, that when the economy, when the private sector grinds to a halt, the public sector has a role to play to prevent something even worse from happening.
Yeah, and it is from a context standpoint. We do have these major events in history, and I think of 1929, 1987, 2008, and 2020 as sort of the big ones. I don't know that I've missed any, and I was out for a walk with my wife, because that's what you now do. You go for a walk with family members during the day, and we were looking at from 1929 to 1932, the Dow fell from about 360 to 30 is what it was at the bottom, which, to your point on fiscal stimulus. So maybe talk high level before we dive into the details about some of the functions of the Fed, how you think about their use of the balance sheet, and TARP, as I recall, which felt like a huge number at the time, was like 800 billion, if I remember correctly. And we've already, in terms of a liquidity and Fed action, have already taken multitudes more. And as a buyer of last resort of municipal bonds and high yield bonds and treasuries and multiple levels of stimulus. What is the role of the Fed in the economy, and how does the economy broadly work for those who aren't as familiar with it, before we dive into the specifics of what comes next?
So the Fed is the lender of last resort. When nobody's there to lend, that's what the Federal Reserve is charged with doing. And so what they're doing now is so you may remember the quantitative easing programs that occurred after what has been known up to this point as the Great Recession, where they were buying government bonds and mortgage-backed securities. They started doing that, but they're also, as you mentioned, they're also starting to buy some corporate bonds, some high yield bonds in terms of exchange traded funds, and municipal securities as well. And so what they're doing is, a lot of these markets in recent weeks, or back in late March, really started to grind to a halt. And if there's no trading in these markets, liquidity in just the system just starts to completely dry up. We are a capital markets based economy. A lot of lending occurs through the capital markets, through the corporate bond markets, etc. And so what the Fed is doing is, by purchasing those things, they're starting to reliquify those markets, and we've seen issuance in the investment grade market just explode recently. That's the good news. The bad news is that the Fed, if some of these bonds that they're buying and holding on their balance sheet, if they go bad, if you have defaults, then the Fed is looking at credit losses, and maybe sooner or later Congress would have to step in and make the Fed, quote, solvent again. If the Fed became technically insolvent because of some of these losses. So they're really treading in some really, use this word again, unprecedented territory here. And there could be some political blowback from all of this if some of these things that they're doing right now were start to go badly.
So I want to take it a little bit in pieces, and I'm gonna set a context, and then I just want to get your feedback. So, as you said, March, yeah, I remember it was about March 23rd, but like the market ceased to act. And I think for a lot of people who are just their day to day, they don't really pay attention to their stock portfolio. They don't really understand that the bond market is much, much, much larger than the equity market and how everything works. But I was looking at the city of Detroit, and in about 2013, the city of Detroit declared bankruptcy, meaning, of course, that they didn't have enough funds to pay their debt back. So they restructured their debt. And at the time, the municipal bondholders got 74 cents on the dollar. So if we think about the municipal bond market now, which is where all the cities fund all of the infrastructure projects, how worried are you about a drop in income tax and a drop in property tax in cities all across America, that they don't have ability to print money, that they have these bonds and projects and government workers and state workers who are now starting to get laid off? How does a city recover 2-3 years? What does this look like from the municipality perspective?
Yeah, so I am marginally worried about that. I mean, if you look at the spending at the state and local governments, together in aggregate, that accounts for close to 10% of GDP. And unlike the federal government, which can run deficits, these guys generally cannot, right? They're constitutionally barred in their own constitutions from being able to do that. So when tax revenues start to dry up, as they are right now, what do they have to do? They have to cut spending. And the last thing you want to do when GDP is contracting significantly, like it is right now, is have to do that, have to cut spending. And so this is, this is another political fight that's occurring in Washington. Do we make the next package, fiscal stimulus package? Up to this point, it's been focused on consumers and on businesses. Do we do this as well to the state and the local governments, right? There are people in Washington who say we need to do that. There's other people who are saying, no, we shouldn't be bailing those guys out. They need to cut spending, yada, yada, yada. And that's a political argument, right? But, if you look back at the recovery from the last recession, one of the things that held that recovery back was that you had all these big cutbacks at the state and the local government. So it'll be interesting with the politics, how it all plays out in Washington.
So, I mean, is there a potential outcome? Because again, and I like how you keep sort of touching on, there is a political element that overlays the economics. And so depending on your slant, whether you're Republican, sort of small government, small spend, small tax, or Democrat, big government, big spend, big tax, that you're cutting down these lines. But you have a fundamental economic question around, should the Fed be buying the municipal bonds so that if they go bankrupt, it's basically the Fed that gets hurt, not the rest of capital, which is an interesting economic argument. Now, if we go one level up to the states, and you alluded to this, and I'll use Illinois as an example, where I think they had come out and said that they wanted a bailout, and part of that bailout was a bailout of their pension, and the state pension was underfunded, and Illinois is one of the states that people believe may go bankrupt sooner than later. And then the governor of New Jersey and the governor of New York have both said substantial multi-billion-dollar shortfalls in their state budget this year because of the falling taxes. How does this come to roost, where Illinois spent a whole bunch, has huge debt, gets bailed out? Montana, North Dakota, as sort of a smaller state, not as big a deficit, doesn't get bailed out to the same effect. What does that do for the state residents and federal taxpayers in terms of the distribution of risk, in your view?
Well, what I would say to all of that would be, so how does one thing that you could potentially do here is, again, it's a political decision. One thing you potentially could do is to give the state of Illinois, we'll use them as an example, give the state of Illinois to give them money at the federal government, because the federal government can run deficits, for Illinois to get through the next year or two. But one thing that you could potentially do there is have strings attached to that. Okay, we're going to, in order for us to give you X billion sorts of dollars for you not to have to cut your payrolls and things like that. We do expect to see these sorts of programs put in place to push down the rate of spending or whatever it is. I mean, the IMF does that all the time with countries that get into problems, right? The IMF will come to a country, Uganda, for example, right? Mm-hmm. And they'll give Uganda $20 billion so it can pay its obligations. But they also say, okay, in order to get this $20 billion, and they do it in tranches, it's not all just one $20 billion. It's, maybe it's 5 and then another 3 and then another 2 or, whatever. They have to make certain checks along the way to get the next sort of tranche. And so what potentially the federal government could do here is design a IMF sort of program for the state of Illinois, saying, okay, you need X billion dollars over the next 3 years. We're going to give you these tranches, but you've got to be doing this along the way for us to continue to give you the money.
So then the big elephant in the room is the feds, because it all comes back to whether you're a company and the federal government effectively mandated a shutdown of businesses. So small businesses and large businesses alike are sort of down. There's the nuance of guys like Amazon, Costco, Target are winning all the business, and therefore probably don't even want to see the shutdown end because, from a purely competitive standpoint, they are the winners, the definitive winners, which seems to be one of the reasons the S&P, which is so heavily weighted to these big Amazon, Google, Apple, Target, Costco, etc., is going up. But then at the same time, all these small businesses that pay and all these governments that pay can't pay. So at the federal government level, with the national debt, the deficit, the incurred costs on the balance sheet for this, how do we undo this or have any semblance of getting back to the way life was in any period of time? And what do you and I guess speaking for Wells Fargo think about GDP contraction, unemployment systemic? What does the government do to undo the damage that we've done in the last 6 weeks?
Well, in some sense, the government doesn't have, or when I say the government, we, the people, who are the government, we don't have much of a choice in this. All right, so you could take a real hardline approach here and say, okay, we're not going to bail anybody out. We're not going to give people unemployment insurance because we're afraid what's going to happen to the deficit in that category. All right, so people who lose their jobs here aren't going to be paying income taxes. The deficit's going to go up one way or the other. Right? And if you take a real hardline approach and we say no, we're not going to bail anybody out, then you're looking at the economy collapsing at that point, and that has so many social and political implications involved, right? If you think things are bad now, if the unemployment rate in this country goes to 40 or 50%, Katie bar the door, right?
What do you think? What do you think the unemployment not only just what will it hit, but how do you see unemployment trending in the next few years? Because clearly that's a big driver for economic predictions you would make for the U.S., right?
Right. So next Friday, they're going to print the unemployment or the labor force, the labor report for the month of April. The unemployment rate will probably be at least 15%, if not higher, maybe on its way to 20%. Okay. But unlike other recessions where if it would go up that high, it would take a while for it to come back down. We're not really expecting that because, we're looking for it. We're not looking for it to go back to 3.5% anytime soon. But we don't think it goes up to 15, 20% and then it stays up there because, the economy is going to start to slowly reopen again. And many businesses that are shut right now, they are getting loans from the federal government. And a lot of these loans will be forgiven as long as they continue to keep people on their payrolls and things of that nature. So essentially, it's a grant. And so as the economy starts to slowly open back up, you're going to see employment come springing back pretty quickly, right? People haven't been to their doctor or their dentist for non-essential treatments for the last month or two. I haven't been to the barber in 2 months. I can't wait to go back to the barber.
Yeah, me either. I'm starting to look like that guy from Game of Thrones, the big red beard. Like I feel like I should be going behind the wall.
So there's going to be pent-up demand for a lot of that services, and these businesses that are shuttered right now aren't. Many of them are not closed for good, and so once the economy starts to reopen again, a lot of those folks are going to be called back to their jobs, and so you're going to see the unemployment rate spike up, but then it's going to come back down pretty quickly. Now it's not going to go back down to 3.5% because some businesses, I mean, they're gone already, right? And so by the end of next year, we still think the unemployment rate is north of 6%. So
by the end of 2021.
2021. Okay. So the bad news is it's not back down to 3.5%, but the good news is it's not 15% either. So, we talk about the unprecedented nature of this. This will be an unprecedented sort of recovery. I'm not going to say it's a complete V, that we go right back to where we were in February. That's probably not going to happen. But I think that the third quarter and the fourth quarter GDP numbers, knowing what I know right now, I think will be pretty strong as more and more states start to reopen and people come back to work.
Now, what do you think about, if you go out 5 years and, I think the number I've seen is the feds have sort of added $6.5 trillion of liquidity. Some of that is forgivable loans. Some of that is purchasing bonds, which presumably they would sell back to the market at some point if things loosened up a bit. Is that a fair characterization, like that they could unwind some of the balance sheet increase and that there would be a demand for that? Will banks like yourself and the other ones pay what they sold it for?
So frankly, I don't think the Federal Reserve will start to unwind its balance sheet. I think the bonds that they have bought will probably stay on the Federal Reserve's balance sheet.
And so they'll get the money back when those bonds come due and pay.
And so what happens is the Federal Reserve buys a bond from the markets, right? And so now the Fed has, let's say it's a 10-year bond sitting on its balance sheet of a coupon of, let's call it 1.5%. Okay, so every 6 months, when the Treasury Department pays that coupon, it'll pay it to the Federal Reserve. The Federal Reserve then turns right around and gives it right back to the Treasury Department. And so again, I don't expect the Fed's going to unwind its balance sheet, because if it did, what you could potentially see is long-term, if the Fed started to sell trillions of dollars of government bonds into the marketplace, that could cause interest rates to move up pretty significantly. And that's kind of the last thing that the federal government wants at this point. I mean, their deficit problems are big enough. The last thing they need to be doing is spending even more in terms of interest.
Yeah,
so that's going to be sitting on the Federal Reserve's balance sheet for the foreseeable future.
And Jay, I wanted you to explain again, just for the listeners who might not be as familiar with how that would work in terms of supply demand. If the government were to sell a whole bunch of bonds into the market, that would presumably depress the prices. But the price that those bonds pay every month or every year is the same. Therefore, the yield goes up, which has the net effect of raising interest rates and making debt more expensive for new issuers. Is that
right? So what happens is if there's a big supply that comes into the marketplace, everything else equal, that causes prices of bonds to go down, which means their yields go up. And then for the Treasury Secretary to be issuing new bonds going forward, he or she has to have a higher interest payment on to make them comparable to the existing stock of debt out there. And so rather than issuing a 10-year note at, let's call it 1.5 with a 1.5% coupon, now in order to make that more attractive, they've got to be issuing that at a 2% or a 2.5% coupon. And so the interest expenses of the government then are going up.
So when you think about long term, I mean, the U.S. dollar has sort of been the world's currency. I would describe it as, I guess, informal, but a lot of oil is traded in U.S. dollars. A lot of debt is denominated in U.S. dollars. So there's a huge global demand for US dollars. With the response to this, I mean, do you have any comments on the euro, the US dollar, and broadly global capitalism as we move forward? What happens to the way we loan intermoney between governments and currencies like the euro? Any comments on that?
So the U.S. dollar is the world's preeminent reserve currency today. I'm going to say the U.S. dollar is going to be the world's preeminent reserve currency 20 years from now. There's no alternative to that. Okay. Now you talk about, a big government debt here in the United States. I'll put this in country music terms. Okay. Johnny Cash sang a song 50, 60 years ago, Sunday Morning Coming Down. Remember that song? I woke up Sunday morning and I fumbled through my closet to find my cleanest dirty shirt. That's what Treasury securities are. They're the clean, dirty shirt. There's no alternative to that. Are you going to, as an investor, invest in euros right now? Well, you think about it, there's not one European government. There's 19 individual ones. And what we learned during the sovereign debt crisis in Europe 10 years ago is that a Portuguese sovereign bond is not the same thing as a German government bond. Japanese yen, no. China, you can't invest well there, and even if you could, I don't think I would touch Chinese government debt. So the reason why the U.S. dollar is the world's preeminent reserve currency is not only because the U.S. has the biggest military might around the world, but also because we have the deepest, most liquid, most transparent capital markets in the world. Europe can't compete with us when it comes to that sort of stuff. Japan has a deep bond market, government bond market, but that's about it. China, transparent? No.
Right.
Right.
Yeah. Ask anyone about the numbers coming out of the Wu flu and see how that worked. Yeah.
So because of the deep and liquid nature and transparent nature of our capital markets, investors from all over the world want to buy equities here. They want to buy corporate bonds. They want to buy sovereign bonds, et cetera, and they need dollars to be able to do that.
So long term, that's good. Now, obviously, gold has been really increasing in price of late. It's my neighbor works for a gold company, and after 8 to 10 years of just being beat down, there's finally euphoria in the gold market again. Well, what do you take of the move to gold? I mean, is that sort of a hedge against weakness in the U.S. dollar? Is it the belief that there's going to be some level of inflation or hyperinflation in the U.S. that assets are going to go up substantially because of the printing money? Or how do you take on gold and inflation long term?
So I think, when I think of gold narrowly, why has that rallied recently? I think it is gold typically does pretty well in terms of, with risk off. When people become risk averse, they tend to buy gold, that sort of situation. Is this you talked about inflation. Is this an inflation sort of thing? That's not really consistent with what you're looking at in the bond market. If you thought there was going to be a big inflation problem there, you would expect to see the steepness of the yield curve be a lot steeper than what it is right now. So I take it as kind of a risk sort of thing. And, assuming we get through this and the U.S. economy and other foreign economies start to open back up again, and people become a little bit less risk averse, then maybe gold doesn't have as much of a luster there. I think so. In the long run, could you have higher inflation in this economy? Yes, that's not going to happen anytime soon. In the next year or two, the biggest price problem that the economy faces would be deflation rather than inflation.
But the deflation would be driven in part because of wages falling with so many people unemployed. It has a tendency of having more supply of workers, less actual jobs, and so people's wages would become depressed, which would be deflationary.
Yep. And if we don't come back quickly, because the virus lingers here and we have to remain locked down for a lot longer than we think. That's a very weak economic situation, and that's how you get deflation, like you did in the early 1930s, right? Depressed economy, we had deflation back then. So now again, I don't think that's going to happen, but if you're talking about risk in the next year or two, that's the bigger risk. Further out, in terms of inflation, okay, so you have this big government debt to GDP right now. And it's interesting when you go back and you look, so it's going to be as high, the debt to GDP ratio in our country is going to be as high in the next year or two as what it was at the end of the Second World War. Okay, and by the early 1960s, we put the debt to GDP ratio back down to where it was before the war. Now, there's a lot of ways that happened. One is that we did have balanced budgets throughout most of the 1950s. But one of the biggest things was economic growth in this country was very strong in the 50s and the 60s. That's, you think about, so you got a debt on the numerator and GDP on the denominator. If you can make the denominator grow really fast, that ratio can come down.
Now, is it fair to say, so you used the Second World War, and two things I remember was, at one point, income tax rates above, I think, inflation adjusted was $1 million a year or something. My recollection was income tax rates were north of 90%, like 90,
they were
92.
They were, and that's the marginal income tax rate during the Second World War at the high end of the spectrum was in excess of 90%. And even one thing that the government did do during the Second World War is they raised tax rates across the board to help to finance the war effort. Now, nobody's arguing, or nobody's saying right now we should be raising taxes right now with the unemployment rate at 15%. But this comes back to the politics again, right? If you are concerned about that big debt to GDP later on, 5-10 years from now, there's a number of ways you can address that. One would be on the revenue side. Another way would be on the spending side. And we've got some issues there. If you think back to the 1950s, what was that? That was the baby boom generation, right? The population of the country was going up.
And right now, yeah, right. I was going to say population in the U.S. and in most first world developed nations is actually falling. We're not even meeting.
We're not falling here, but in some countries they are. But the growth rate, the population growth rate here is very slow right now. And so the point here is it's going to be harder to engineer stronger economic growth. One way to have stronger growth in nominal terms, not in real, but in nominal, is to have a higher inflation rate.
Right.
And so potentially the federal government could be going to the Fed and saying, you know what, one of your mandates is price stability. That's embodied in the law. Federal Reserve by law has to bring about, quote, price stability, which they interpret as 2%. Congress at some point could go to the Fed and say, you know what, forget about 2% inflation. We want to see you have a 4% inflation rate to try to inflate away some of this debt.
Now, this is a great topic because I remember my economics class in my MBA, and the concept of inflation it's kind of mind blowing to me because on a relative basis or a real basis, if you make $1 and bread costs a cent, it's the same as making $10 and bread costing 10 cents. Right. And yet there's this desire for people to feel richer. And so if you go back in the last 5 or 6 years, wages haven't kept up with generally, the cost of living increases. And certainly we'd seen the stock market as a proxy had really risen as wages weren't rising. And to your point on inflation, wanting to target 4% inflation, what from an economic perspective, what is the benefit of that?
Well, in some sense, the only benefit is if people don't expect it. If people expect it, then that starts to get built into all sorts of expectations, right? If you think prices are going to go up 5% next year, everything else equal, you're going to want to try to get a 5% wage increase or salary increase to try to make up for that. There's, at the end of the day, there's really not a huge benefit to high inflation rates. I mean, the inflation rates that we have seen in the last 20 some years, they haven't been nettlesome at all, right? It's only 2%. It's not that big of a deal. People can certainly adjust to that. The problem with higher inflation rates is when you go back and you look at history, the data will show high inflation rates are also, they tend to coincide with very variable inflation rates, okay? So there's a lot of uncertainty. So one year it's 10%, the next year it's 2%, and then it's 15 and back down to 3. It just moves all around, right? And that's hard in that circumstance. If you're a business, it's hard to plan for that, right? You know, so how much can I raise my prices next year? 15%? Can I raise 3%? And so if you have all that uncertainty, everything else equal, it makes businesses not want to invest as much. When they have certainty, that's a good environment for an investment spending.
So I love that you touched on uncertainty, because one of the things that I would say as an entrepreneurial person is there is now a risk premium for a entrepreneur to start a small business, because the risk that the government could just shut down, or another lockdown because we have another wave of infections, or we have another coronavirus in 2020 that's a totally different one that we can't vaccinate. This precedent has now been set. So the demand rate of return, you would think, is going to be higher. And on top of that, like I think about Boeing all the time, who was already having issues, and I won't ask you to comment on Boeing specifically, but as a context, the 737 MAX issue was a bad issue. And now all the airlines, which are heavily indebted, have no passengers, no revenue, and uncertainty as to how many passengers will fly and at what rate they'll go back to flying the way they used to. Well, that means, why would I buy and invest in a new plane? And oil is $10 a barrel. I don't need any fuel efficiency. So then all of a sudden Boeing becomes unstable, United becomes unstable, those jobs become unstable, and there's this massive uncertainty premium that hasn't been built in for the last 10 years. How much risk is that?
Well, and so that's a risk for Boeing. That's a risk for some other sorts of companies. That's great news if you're Zoom. Right? Before this pandemic, how many of us had heard about Zoom or these other sorts of platforms? People will continue to conduct businesses, and there'll be ideas that are generated to help people trade and not only financial products, but goods and services, things of that nature. So yes, will some companies be forever set back because of what's happened? Yes. But will other companies have a breath of fresh life here because of demand for new sorts of products? Yes. And, the economy evolves over time, right? It's always evolving. The economy today, that looks nothing like it was during the last pandemic, the Spanish flu of 100 years ago. And we wouldn't want it to look like that either, right? So it's more of for me, it's more of a microeconomic concept. Yes, it's bad news for company X, Y, and Z, but it may actually be good news for company A, B, C, and the economy will revolve.
So overall, you sound fairly optimistic. I mean, it sounds like there's some risks, but generally optimistic in the short and medium term is what I'm interpreting. And we've sort of touched on maybe the boogeyman in the room, which is the long term, and certainly the national debt, the debt to GDP ratio. We talked about the Second World War, and really Europe was totally destroyed. And so the economy really resurged in the 50s because you were rebuilding, and there was so much demand for that, at least as I interpret it. What are there some long-term risks around both increasing tax rates and increasing and systemically higher unemployment? Do you see some long-term risks as we deal with this debt deficit coming to Social Security? Like, when do we pay the piper, I guess, is my question, because you sound optimistic.
So in general, let me address that. In general, I am pretty optimistic. Because this is what's happening right now. This is a public health crisis. This is not really an economic crisis. The GDP is going to go down 20% or so in the second quarter, not because there was anything fundamentally wrong with the economy. It's because we locked down because of a public health crisis. So once that public health crisis passes, then yes, I am generally optimistic. I think the thing that we can overdo is to get all concerned about the debt to GDP ratio in this country. We don't have to go back to where it was before. We need to stabilize it, and that needs to have good public policy. But is increasing. I'm not necessarily an advocate for higher taxes, but there's a range in which you can do it, right? If we increase the marginal tax rate from 33% to 39 or whatever, is that going to kill the economy? No. That's what we did back in the 1990s, and as I recall, the 1990s were pretty darn good years. So it has to be a balanced approach, and I think that if we retreat into our corner, the thing that I get really, I guess, maybe concerned about is if we stop having a conversation, we retreat into our corners and take a really dogmatic approach. It has to be all on the tax side, or it has to be all on the spending side. We need to have a fiscal adjustment. We don't need to have it right now. That's further on down the line. We need to have that. But it's going to take for it to be a credible fiscal adjustment. Both sides have to compromise.
It does feel like
we haven't done that very well in the last 10 years, and that's what concerns me is the political response.
Yeah, and you're exactly right, because it does seem, and you've been around longer than I have in terms of your professional career, but it feels like it's the most polarized politically it's ever been, and everyone takes this as a health crisis too. Well, this is the evidence we need, universal health care. This is the evidence that we need, whatever. It's being spun, and to me, it does seem like whoever gets power in 2020 at some point during their term is going to have to raise taxes and cut social services in order to get to some semblance of balance, which, the federal deficit is in part driven by $1 trillion in Medicare and $1 trillion of Social Security. Do you think that politicians will be able to address that, given they're elected officials and don't really want to do either of those things?
Well, I sure hope so. And we just said a few minutes ago, in general, I am optimistic. Again, when I put my gloomy hat on, and I don't do that very often, but if I do put my gloomy hat on, I recognize that democracies sometimes tend not to make difficult political choices until they're forced to do so. And so you would hope there are adults in the room that can have an adult conversation and say, how are we going to get out of this? Or we can continue to fight, and then the next crisis may be when the rest of the world decides that they're not going to buy our government bonds. And when that happens, that will be a mess. And yes, it will take, we'll make the adjustment at that point, but it's going to be a mess. And so I do hope and do pray that we do have an adult conversation in the next few years. But again, when I recognize democracies tend not to do that.
Something I hadn't thought about until you just said it was the concept around with a higher unemployment rate. In order for the U.S., I think that even in 2016, Trump ran on "Make America Great Again," which was in part bringing jobs back that we had previously offshored. And if you have higher unemployment, you would bring some of these manufacturing and certainly essential pharmaceuticals, which we're short of, PPE, which we're short of. Some of these might come back to the U.S., but the more we onshore jobs we've previously offshored creates less demand globally for our U.S. dollar, which does sort of exacerbate the whole we're no longer the global currency and we don't have lenders. Do you see that interplaying at all, or are we still the big kid on the block, so countries will just adjust?
Yeah, so we I think we'll be the big kid on the block. Let me bring up another concept here, and that is the current account deficit, right? The president makes a big deal about the current account deficit.
Could you define that for listeners?
So essentially what it is we import more than we export. Okay. And the reason we do that is we here in this country, we tend to, we consume a lot here, right? Consumers consume a lot. And businesses' investment spending is really strong here. Okay. So because we spend more than we produce, we have to get some of that from abroad. Okay. And we could correct that overnight just by not trading with the rest of the world. Okay. Well, if we did that, there would be huge disruptions. If we just closed off our economy, we said, okay, we want to get rid of this current account deficit, and we're just going to close off our economy from the rest of the world entirely. That's hugely disruptive to the economy. And so as long as this process occurs in a slow, gradual sort of process, that's fine. But if we try to do it all at one time, that's going to have major negative consequences for the economy.
So it definitely feels.
I do think that some of that you will probably start to see, and we already were starting to see more and more kind of onshoring occur. Many businesses had recognized even before this coronavirus thing that their supply chains were getting a little bit too stretched, a little bit too cumbersome. It's not only coronavirus that can shut things down. A strike on the West Coast can do it. Airplanes not being able to fly can do it. There's lots of different things that can cause this. And so businesses were starting to bring some of that stuff back on shore, and this coronavirus will probably accelerate that somewhat.
It feels like we're really walking a very, very tight rope. And if we take all the correct actions and the correct steps, then things can be good. But there does seem like there's a lot of ways that if we walk off the line, there's a lot of substantially bad things that can happen. Is that?
Yeah, and part of the reason is, I'm going to go back to this word that, again, is a cliche. It's this kind of unprecedented. We don't have a playbook for this, right? We have not seen a global pandemic in almost 100 years. And so, how do you respond in a global pandemic? I don't know. We're making it up as we go along. And so that's, it does leave maybe your margin for error a little bit less than what it would be, just because we haven't seen this in our lifetimes.
So last question for you, and again, we talked about the bond market being bigger than the stock market, but macro, there are choices to make, which is you can be dogmatic and just let things fail and see what happens, or you can be, I'm going to call it pragmatic, which is to sort of help ease. The stock market continues to just fly, and we're back to 2,900 in spite of whatever is going to happen in Q2 earnings. And it seems to be projecting like a pretty solid return to the way things were. How do you see the stock market tying back to the realities of unemployment and small businesses and the dichotomy maybe there that small business owners are really potentially going to struggle, but these large, massive companies are doing really, really well and driving the stock market to new highs, which seems to be positive or negative, or what's your take on it?
Well, again, I mean, we're not back to, in terms of the major indices, we're not back to quite where we were when this whole thing started. The stock market is always forward looking, and so it's starting to price in some fairly optimistic sort of views right now. There's the optimism that states are starting to reopen. There's an optimism that there may be some vaccines that are available sooner rather than later, that we can potentially return back to some sort of semblance of normalcy. Yes, the unemployment rate in the near term is going to go shooting up, but stock market is forward looking. It's looking beyond that. And so I think the biggest risk for the stock market right now is if the virus doesn't go away, right? And that, you and I are having this conversation 3 or 4 months from now, and we're still sitting in our homes because we're still at lockdown sort of orders. There's a potential for us to come back too quickly. We'll see how that goes. Then my guess is the stock market's going to sell off on that.
Right. Well, Jay, very interesting conversation. I think never before in the history of the world has economics been such an interesting and relevant topic to 99% of the population. And hopefully the listeners were able to hear some of the concepts that maybe they've been hearing in the news, but they hear in 20 seconds, and to have a deeper conversation into inflation and the Fed Reserve and bonds and pricing and the way an economy works, I think is really, really helpful. And I really appreciate you spending the time. It must be fun to not have to wear a suit every day. My view of bankers is everywhere you go, it's always suit and tie. And so you've got to have like 6 weeks of golf shirts. How is that fun or what?
I've been actually working in flannel shirts for the most for essentially 8 weeks now, and I was saying this to my wife a night or two ago. It's going to be hard putting a tie back on.
Right. I wonder if dress codes are really going to change. I mean, for
That'll
me,
be interesting. And I think another thing will be interesting will be, do we in fact actually start to go back to our offices again? Or I mean, I think many of us who have the luxury of being able to work from home. Many of us are finding that, geez, we can be pretty productive at home. And I do think that does have implications for things like commercial real estate, and things of that nature. Do we need as many office towers 5 years from now as we do right now? That's an open question. I don't know. But it'll be interesting to see how this changes behavior, on a more, quote, permanent sort of basis.
well, if there's one thing we know, humans and economic capitalist systems adapt to stimulus. And so whatever the future holds, we will be adapting very, very quickly. So thank you again for joining us. For everyone else, we appreciate you joining the Hot Take of the Day podcast. If you have comments or questions or topics for suggestion, please send me an email at drw@hottakeoftheday.com. You can catch up on all the old blogs and podcasts on our website at www.hottakeoftheday.com. Subscribe to our morning blog, subscribe to the podcast, write a review, and until next time, be safe, be good, have a great day, and bye.